Okay, got a pretty exciting weekly outlook ahead. Give me a minute here. Our hat sale, we have sold 74 to date. Our target is 200, so we've raised 4,440 US for Pathstone Mental Health. Each hat is 30. For each hat sold, I then match it with another 30 US to make a $60 donation. 60 times 74 is this number. If we hit the 200, this would be 12,000 US, which translates to somewhere around 15, 16,000 Canadian. I will then bump it all the way up to 25,000 Canadian. So another 126 hats to go. It is, as of today, November 27th. Sales are to December 15th, so purchases will be available to December 15th. Your $30 donation ends up being a $60 donation to Pathstone, and if we hit the 200, it ends up being almost a $90 donation to Pathstone from 30 bucks. So if you like the hat and you like giving back and supporting good charities that are doing good work, there's a great opportunity to buy some merchandise and turn this $30 easily into $60 and potentially $90. Okay, a lot to cover today, and a few new things I'm going to introduce for you as well. Let's begin with our rates. Money market rates have all increased the most from the 1 month all the way down to the 1 year, only 2 basis points. This is in line with the next Fed meeting on December 14th, where the expectation is 50 basis points. Money market securities will start to price that in ahead of time. Capital market all have decreased, and this is to reflect the expectation that there will be lower rates in the future, so that we may have elevated rates for 2023, but then they'll start to drop in 2024, 2025. So if you're thinking about a 5-year security, 3 of those years will be lower and lower rates. If we assume that 1 year is going to be fixed, and then through 2024 you'll have some reduction, and then it keeps going down. That's why these are pulling back. So this could be pulling back. Well, it is pulling back because of the expectation of lower rates, and that expectation of lower rates could be because of the expectation of lower inflation or a recession. So that is the fight right now, is are we going to get a soft landing or a hard landing? If we get a soft landing, inflation will come down, everything will be fine, growth won't turn negative, growth will be positive but low, but it won't turn negative and will be just okay. Whereas the recession, we're going to have negative GDP growth. Then it becomes a question of, are we going to have mild, moderate, or a severe recession? So we'll introduce Okun's law later and look at the relationship between GDP and unemployment, and look at some cutoff values for mild, moderate, and severe recessions. If we look at slope, we are getting some indication of a greater vote for recession. Last week, we were at negative 69 on the 2s and 10s. We're now at negative 74. It was a shortened week last week, so, is that move because of the shortened week and lower volume? Lower volume tends to have larger moves. Same with the 3-month to 10-year went from negative 52 to negative 73. These are big moves over here. For the 2s to 10s, 144 days now, negative 74. That is a new low. And for the 3-month to 10-year, negative 73. That's been 32 days. That is a new low. It has now taken out the February 07 low on that inversion, and we're sitting just 4 basis points above the December low. But again, last week was a shortened week with lower volume, so it's, we'll put a question mark in that right now. But still, on the 2s and 10s, negative 69 to negative 74, that's not so bad, but negative 52 to negative 73, maybe that was just a mistake. One thing is certain here. When we look at this inversion on the 2s to 10s, we're looking at depth and duration. Depth of negative 74, duration of 144. This now has a 100% record. If you go back to the historical record, never has there been a time where an inversion has been this long and has gone that deep where there has not been a recession. And this is 100% as well on the 3-month to 10-year, excluding the pandemic year. Had the pandemic not happened, all the indicators were pointing to a recession there anyways, but we'll never know. So if we're thinking, are capital market rates beginning to reflect lower inflation or higher recession? If we look at slope, it is saying higher recession. Let's look at the Fed balance sheet, down another 4.8 billion. That's all MBS, no treasury maturities over that period of time. 8.109 trillion versus 8.114 trillion, 80 billion month to date, but one of these dates, November 2nd, I'm counting all the decrease as part of this 80 billion. Well, that November 2nd also had some days in October. So that 80 billion is not really all of November. It is the last part of October that's included in there. So the next reading we get is November 30th for the end of the month. And you have treasuries that mature over that period of time. So I expect another big drop down next week. I think, being that we're near the end of the rate hiking cycle, and I think we are, regardless of what CPI reading we're going to get on December 13th, even if it goes back up, I still think we're near the end of the rate hiking cycle. Based on the minutes that we read yesterday, if you watched the video that I put up on Saturday, they didn't have the benefit of seeing the CPI reading at that the minutes are reflecting the meeting of, and in that and in the minutes, even knowing inflation was hot, that was going in the wrong direction, they were still signaling that it was time to slow down. So even if on December 13th inflation ticks back up, I still think we're near the end of the rate hiking cycle. The market also believes that as well. If we look at Fed funds futures, June and July bottoming, the index bottoming at 94,995, which implies a rate of 5.005%. Last week, it bottomed out at 94.93 in July, which is 5.07. December is 95.295, which implies a rate of 4.705. So it looks like we've got one 25 basis point rate cut sometime in the fall. Last week it was 95.27, which is 4.73. So this has moderated a bit back towards 5%, and this has come down just slightly, reflecting the drop in this rate up here. To get more confirmation, we can look at interbank rates, 1 month interbank and 3 month interbank rates. So look at the futures here. For 1 month, May, June, July, all sitting around 95.02, 95.02, 95.01 for 3 months straight, implying a rate of 4.98%. The 3 month in August has an index reading of 95, implying a rate of 5%, 4.98, 5%, 5.005. Well, that's the end of the year. We can ignore that. This is all fairly consistent all around the same area. So there doesn't seem to be any disagreement in the market. And listening to Fed speak, it seems 5% is the number that's being thrown around. 5, I've heard 5 to 5.25. So we're at 4. If there's another 100 or 125, that's about it. We will see another CPI on the 13th. We will see PCE in the week coming up on December 1st. We'll see PCE. I don't imagine PCE will be out of line with the CPI we saw earlier this month. It usually has a high correlation, albeit at a lower level. So if December follows suit on the 13th, maybe we see this pull forward. If it doesn't follow suit, I don't know that we see this go higher as much as we see this go longer. Because I think that 5 to 5.25 pretty much is what everyone is thinking, and I think the Fed is looking at that saying, yeah, that's probably about right. So I don't know that the rate would go much higher. I think it would just stay there much longer. So I would be it would be more likely to see it extend than increase. But it could increase, depending on how hot this is. This might then find its way up to 5.25, and it might be August to September. You might get both, an increase up and a lengthening of it, which would be negative for equity prices. Probability of a rate hike, weight is still on the 50, and it hasn't changed. I had to refresh because I thought, oh, you're giving me last week's. It's just serving a page from memory. Let me refresh and get the newer page. But I looked at the time, and nope, it was up to date. 75.8 on the 50, 24.2 on the 75. I don't think this is going to happen. I think this is overweight on the 75. I think as we get closer to December 14th, I think the weighting is going to be firmly on the 50. After reading the minutes, I don't think that they would have taken that much time discussing the December hike or even mentioning it in the minutes if they weren't really signaling that it was time to step down from the 75 basis point moves. Okay, real yields, all of them decreased, some significant decreases in real yields. And what do we have for break-even rates? They've all increased. Well, this is not consistent with capital market rates going lower on the expectation of lower inflation. The break-even rates have actually gone higher, but capital market rates have gone lower primarily because real yields have gone even lower than capital market rates. This kind of hints to me that there's more recession fear than soft landing. If we look at volatility of treasuries, this is yield volatility. This is something new that I'm going to introduce, because if we are expecting the end of the rate hiking cycle, we will see volatility reduce on treasuries. And if you see volatility reduce, this has a couple of effects. Number one, it's going to draw more money into duration because the yields are quite high. What is unsatisfying about high yields is if you also have high volatility. You don't want that. If you have high yields with low volatility, hey, I'll take that. And I think a lot of funds, when I say funds, I'm talking about pension funds, institutions, endowments, insurance companies, who could never, for the past, 12, 13, 14 years, get any yield out of fixed income at all. They were forced to take on risk, can now get yield in fixed income. So if you have the volatility dropping on treasuries, and if we are near the end of the rate hiking cycle, volatility will drop. That is supportive for equity prices as volatility begins to drop, even in treasuries. However, it's also competition for equities as well, because as volatility drops on those yields, money will be drawn into it. So let's just have a look at what we've had over the past little while. This is June 6th to November. This ends here. This tick is November 21st. This is all the way to November 25th, as you can see up here. May 27th to November 25th. This black line here was the September meeting, a raise of 75 basis points. Notice the volatility increase across all. We're looking at the 30, the 10, the 5, and the 2-year. And at the peak over here, at the peak of Treasury volatility, the market was at 36.47. So 37.89 down to 36.47 as Treasury volatility increased. Then you had a slow decrease, and we pretty much ended, if you look here, we pretty much ended almost the same. Look at where the S&P was at this point in time. This is November 2nd. They went another 75 basis points. 37.89 to 37.59. But in going this 75 basis points, look at the interesting that happened. You had Treasury volatility drop significantly, bottomed out November 11th, and then started to increase. Well, the volatility of short rates is going to be a lot higher than volatility of long rates when rates are high. Because the short rate will start pricing in the Fed funds rate, will start pricing in monetary policy, whereas long rates weren't. So if you take out, let me just back out some messiness here. If you take out the V over here and you look at where the 30 went, volatility on the 30 went down. This line up here is the 2-year. Volatility on the 2-year went up because it's going to price in monetary policy, but the volatility on the 30-year went down. And just above that, there's the 10-year. So if we look at where the 10-year was here, volatility's been flat on the 10-year, which means it probably dropped on the 20 and all the way to the 30. That's going to create competition for equities because it's going to accept inflows. I'm going to talk a little more about yield volatility and issuance in a little bit, but I do expect this to continue. Yield volatility to drop. And if yield volatility drops, spreads will tighten. And we have seen that when we look at corporate spreads. We have seen that corporate spreads are tighter over the last, well, we've been surprised at how tight corporate spreads have been. They just haven't really blown out that much, not as much as we would expect. But there is an interaction between the dropping of volatility in treasuries, the tightening of spreads, along with the issuance. We have to look at issuance to really understand what's going on here. So we'll look at that shortly. Let's look at unemployment, because if we are thinking about the Fed, it's not just the level of inflation, but the level of unemployment, because they have a dual mandate. Is there anything here? Plus, we get a jobs report next week, December 2nd. We get the jobs report for November. So November 5th, 226. November 12th, 223. November 19th, 240. Well, that's interesting, that little jump. November 26th, got a question mark here, but these are all well below 275. So December is going to print a positive jobs number. I can't see why it wouldn't. Now we have an ongoing issue throughout the year between the difference of the household survey versus the establishment survey. The household survey sets the level of unemployment and the participation rate. The establishment survey tells us how many jobs were created. And there's been a discrepancy between the two of them all year. So it's, when we get the report, it's like, well, which number do we believe? We're not really sure. However, the establishment survey correlates with this a lot better. And this is objective because you can actually count the number of initial claims to the claim. You can count it to the claim, and the establishment survey correlates with this. So for as far as job creation, I tend to side with the establishment survey. What's interesting this week in this one is the non-seasonally adjusted. Look at the difference in non-seasonally adjusted. If we look at seasonally adjusted, initial claims went from 223 to 240, an increase of 17, but non-seasonally adjusted 48,000. And when we look at the insured unemployed, it went up by 107,000. Non-seasonally adjusted. Well, non-seasonally adjusted are this is actual real stuff going on. Seasonally adjusted is saying, yeah, okay, so you have 107,000 that's actually going on, but every year at this time there's an increase. So to get the true difference, we look at this number 48 saying, okay, well, of the normal activity we would expect to see, we saw 48,000 more than that normal activity. So it gives you a better idea of the trend by taking out the seasonality. But in reality, if we're looking at aggregate incomes and spending power, this is how many people, 107,000, are now on unemployment. It has increased by 107,000. Almost 48,000 people filed for initial claims last week. Those are real people. 17,000 more than would normally go, but still it's 47,000. So there's some information in the non-seasonally adjusted as well, because this represents purchasing power in the economy, right? This is the loss of purchasing power because it is the loss of an incremental loss to aggregate incomes because of that. But these are just people who are showing up for initial claims. Once we see the jobs numbers, if they're positive, it means on net, even though some people lost jobs, more people got jobs. You might have 600,000 people who got jobs, and you might have 400,000 people who showed up to unemployment, and your jobs report would show 200,000. Well, with 200 and something per week, you're probably going to have more like 1 million jobs created, 800,000 jobs lost, something like that. so that you have the net increase of 200,000. Okay, here is a longer chart of yield volatility. Some interesting relationships that you should be aware of here. Look at our time period is January 4th, 2019 to November 25th. And I just wanted to show you where volatility, yield volatility, is sitting now compared to where it was in the past. The 10-year, if you take a longer term chart all the way back, I think this goes all the way back to 2014 on this site. This is the CME. You just have to, you need an account to get to this data, but it's on CME. The 10-year typically ranges 50 to 100 in this range over here. And the 10-year is up around 150 right now. So it is elevated volatility, but it is coming down. Notice this relationship here. This spike over here, this was the pandemic. The target rate was cut to 0.2% very fast. And because it was done very fast, you have this big spike in volatility, and then it comes down because rates were held low. And bond buying started, which pushed down longer term rates as well. Look at the lowest volatility was on the 2-year. The highest volatility was on the 30-year over this period of time. When you have low rates and the Fed is sitting on the curve, in other words, it's holding rates low for an extended period of time, longer yields will have more volatility than short yields because monetary policy is not moving. At high rates, short yields will have more volatility. You can have low rates for a very extended period of time. In the historical record, high rates, as you're moving rates high, they don't really stay high for very long because they usually kill a lot of stuff on the way, which means it doesn't take long before they have to start to be lowered because you've destroyed so much. You now have a recession and you're contracting on GDP. You got to lower those rates. So at higher rates, short rates tend to have more volatility, and that is what we're seeing. This orange line down here, there's the 30-year, and this line up here, there is the 2-year. So the 2-year is reflecting monetary policy. If we look at skew, we have 2-year skew of 9.33, and how this is done is you first have to look at interest rate options on price, and you look at calls and puts, and you look at the implied volatility on calls and puts and determine which one is higher or lower, and then you can calculate your skew. Your skew on price is opposite for yield because price up yields down, right? So it'll have opposite signs. So negative signs are bullish. Positive signs on price are bullish. So the 2-year, 9.33, well, that's reflecting monetary policy. But look at the 30-year, negative 6.59. And what this means here, this 9.3, it's positive. It means if we're looking at price, the implied volatility on puts is greater than the implied volatility on calls, denoting that the expectation is for more downside risk to the 2-year price. Well, if there's downside risk to the 2-year price, there's upside risk to the yield. Higher yields, lower prices, right? But lower yields, higher prices. Here, for the 5, the 10, and the 30, the 5 and the 10 are very close to zero, but look at the 30 at negative 6.59. The implied volatility on calls is greater than the implied volatility on puts, meaning more demand for calls on a price basis than for puts, which means there's a belief that price is going to go up. Because if we expect a drop in volatility for many funds, that's a time to add duration. And they're not going to wait for volatility to get all the way down to add duration. They're going to anticipate that volatility is going to drop, and then they're going to add duration. You don't do something after it's happened. You do something in anticipation of something happening. So they're adding duration. And adding duration, you can add it in a number of ways. One is to actually just buy calls on the 30-year bond. So the implied volatility of calls is greater than the implied volatility of puts. You have negative skew, which means you have a desire to add duration. And as volatility, or as the expectation of volatility continues to drop, you will have the skew on the 30-year probably increase. You'll start to see it on the 10. So the question is it time to add duration? Well, the market seems to think so. The participants in the market seem to think so, based on the direction of where volatility is going, based on that skew, based on where the yields in capital markets have gone. The 30-year has dropped 18 basis points. The 10-year only dropped 14 basis points. The 30-year dropped 18, yielding 3.74. So there is money going into capital market bonds. And if this expectation continues, which I think it will, then yes, you're going to get money flowing in. You have the Fed leaving as institutions are coming in, but issuance is dropping. So the idea that the Fed needs to stop QT doesn't make a lot of sense, because they're leaving while institutional money is coming in. I don't see how that's going to affect the operations of the Treasury market. When the Fed moved in, it crowded out a whole bunch of private money. That private money, mostly pension funds, endowments, and insurance companies, had to step out on the risk curve and move into equities. Well, the Fed is now leaving, so that allows them to come back in at higher yields. They're coming in at a 30-year yield of 3.74. At the beginning of the year, that was 2.01. The 10-year at the beginning of the year was 1.63. Now it's 3.68, more than double what it was at the beginning of the year. So for many funds, this is good. They'll take it, especially if they have a belief that, you know what, inflation is really going to drop and interest rates are going to have to drop sometime in the next year. I may as well grab duration because I may as well grab the 30-year, because I'm going to have big duration. And if interest rates are going to drop, what's going to happen to price? I don't need to be in equities to get price appreciation. I just have to be in the 30-year right now. So they're moving into the 30-year saying, yeah, 3.74. It's a lot better than 2% at the beginning of the year, but rates are high. Volatility is dropping. And if we expect inflation to drop, this is a way better place than tips. And look at that price appreciation we're going to get on that. Well, this is going to be competition, money flows. This is going to be competition for equities because, again, the Fed is leaving. It's not as if they're staying, and new money coming in has to compete with the Fed, and there's just not enough, so they're going to stay in equities, or the extra money is going to spill over in equities. The Fed is leaving, opening up a big hole for this money to come into. Although issuance is dropping, so we'll take that with a grain of salt. That is the Fed leaving faster than issuance is dropping? Or is the Fed leaving slower than issuance is dropping? If the Fed is leaving slower than issuance is dropping, then the runoff on the balance sheet is no problemo. If they're leaving faster than issuance is dropping, that could be a problem if money flowing in from institutions can't fill the hole. How can we tell? Well, we can look at issuance and we can look at the bid to cover ratio. The bid to cover ratio is healthy. It's not as if it's 1.1 to 1 where it's like, ooh, that's low. It's still between 2 and 3. So if there's $100 billion worth of bonds to be issued, there's a demand for 275 to 300 billion of that. I said 100 billion? Yeah, of that 100 billion. 2.75 to 3 times what it is. That's called the bid to cover ratio. So we'll look at that shortly. So I don't think the runoff of the balance sheet is going to be a problem. I think this trend is going to continue, which means more money is probably going to flow into the 30-year first, because the 30-year has big duration, so that when you're ready for rate cuts because of a recession, you're going to get really great price appreciation. And if you are positioning for a recession at this point in time, you probably don't want to be in equities. You want to be in duration. Even if there is still some rate increases to go, you're willing to take maybe some small negative returns on your 30-year because you're positioning for a recession. So this is consistent with a recession as well. Okay, let's look at our spreads, the OAS from IG all the way down to CCC. All of them have contracted over that period of time. 3.4% on investment grade, 5% contraction on high yield over the week. All fairly in line. The higher end of a high yield seems to be getting a lot of attention. Negative 7.74, 24 basis point contraction. Look at this. Hit a high of 422. It's sitting at 286. The high yield on July 5th hit 599, sitting at 451. That's 25% lower than where it was before. So there is not a lot of concern on spreads, and as the volatility of Treasury yields drop, spreads will tighten. If we look at yield, this is the spread. You'll notice that these spreads up here, this 1.42, there it is right there. And then this is just adding the appropriate Treasury on to get to the yield. I've reproduced the 2-year, the 5-year, and the 10-year yields here: 442, 385, and 368. High yield, investment grade or high grade debt, when it's issued, usually has greater than 10 years on issuance. The high yield is usually the majority of it is 7 to 9 years on issuance. So you'd use for high yield, it's probably using somewhere between the 5 and the 10 year. Whereas for the investment grade, it's probably using the 10-year, if maybe not even an implied 15-year. Issuance is the problem here. So one of the drivers of the spreads right now contracting is issuance. If we look at investment grade, less than 100 billion per month since May of 2022. The green is investment grade. Has been less than 100 billion a month in issuance since May of 2022. And if we look at high yield, there has been 22.4 billion total issuance August, September, October. Over a 3-month period, there has only been 22.4 billion issued. Typically on high yield, it's all buy and hold. When you think about 22.4 billion, I mean, one fund can pick all that up without much of an issue. So there's not a lot of high yield to go around, and many of these bonds don't trade. Once they're bought up, it's done. It's not uncommon to see some bonds have 0 transactions over the course of the year. Investment grade, depending on which bonds you're looking at, there's some liquidity there. However, because issuance is dropping, it wouldn't be surprising to see liquidity disappear. And funds still have to hold this stuff. Well, you got to get a hold of it. If you're a bond fund tracking an index and the index has a particular issuance in it, you either have to get it or risk underperforming it, or you have to get your exposure to it in a different way. So that is probably something that's keeping these spreads rather tight. Let's look at issuance on treasuries. Okay, this is the Treasury Watch tool. I can see that I am logged in, so I think you might need to log in for this. So I don't think that I can put a link in the description box. If I do put a link in the description box, you would just get to this page is not available. However, if you are on the CME site, you can create an account. It doesn't cost you anything. You can go ahead and create an account, and then when you log in, you can just find the Treasury Watch tool. If you look at this menu here, more quick strike tools, you can always find it on here. Let's see where it is. So you have the Fed Watch, the Bank of England Watch. There's the Treasury Watch right there. And this STIR, this is really interesting. This is short-term interest rate analytics. Really interesting stuff. Anyways, let's scroll down here. This is the Treasury Auction tool. We'll show the chart. And let's go 3 years out and get rid of the 10-year. So here's 5-year issuance. Actually, if we look at all, you can see how it really increased here and how it's really coming down. This is issuance of the 5-year. And we can look at the 2-year. We see the same pattern. We see it coming down over here. Look at the 3-year. See the same thing. Look at the issuance coming down. Look at the 4. Well, the 4 years new, so that we can get rid of that. There's the 5-year we've seen. There's the 7-year. Same pattern over here. Let's just go for the last 2 years, and we'll start with the 2-year here. Watch the top corner up here. You see how much is being issued. You see the bid to cover ratio, and even down here, look at that: 2.64, 2.84, 2.5, 3.13. There's a 5.32. So there is ample demand for treasuries. Even if we go to the 30-year, and let's just get rid of the 2-year and look at the bid to cover, well in the twos. So here, for example, you see the 30-year, $8 billion, and 30-year bid to cover 2.69. That means 269% of the 8 billion. There wasn't enough to go around. When you start getting bid to cover ratios of less than 1, that means the Treasury can't even sell what it's trying to sell. But we have a decrease in the amount being issued as the Fed is leaving that market to begin with. And you have other funds that are moving in. So if you didn't have the Fed moving out while issuance was decreasing, there'd be a shortage. So the Fed is really just getting out of the way of the private market. So even though you may hear over the next couple of months some talk about, well, the Fed's really got to take care of this QT. It's got to stop doing this. This is going to have a bad effect. Not that I can see. Again, issuance is dropping. The Fed is moving out at the same time. So the spread between what's available for the private market is probably shrinking if the Fed is not leaving faster than issuance is dropping. And issuance is dropping, why? Because that's the beautiful thing about inflation, is it raises tax revenues without raising tax rates. So as far as the finance office of government is concerned, whoever's taking care of the finances in there, the Treasury, they're probably saying, this is pretty good. This is pretty good. We can take care of a lot of problems right now if we can keep inflation high for another year. This is good. Whereas the Fed is saying, oh, we got to get inflation down. So there is a benefit to inflation. All right, mortgage market, 30-year fixed, 6.58%, down 3 basis points from a week ago, up 3.48 on a 1-year change. I kind of like this output a little bit better than what I was using before. 4-week average 6.81, 5-week, 52-week average 5.03. You can think of these as moving averages. This is a 252-day moving average. This is a 20-day moving average. You may say, hang on, 4 times 7 is 28. Yeah, but 4 weekends, right? So nothing happens on the weekends. So a 20-day moving average and a 252-day moving average is slow and a fast. 5.9 on the 15-year. This is over the course of the last year. You can see it rolling over. But we saw this over here before this happened. So is this another one before we have an acceleration? It depends on where inflation is going, and if the Fed feels that no, 5 to 5.25 is not enough, it's going to have to be 6 to 6.5. Only time will tell. Median listing prices, this is from Realtor.com, 11%, week ending November 19th. This is for the same week year over year. The week before was 11.1, 11.7, 13.8, so they are coming down, but they're not crashing. Given that we've done this, to still be double digits year over year, that's not too bad. Active listings up 49. They are increasing, right? 42, 45, 49. 7 days slower. It was 8 days slower. It was 7 days slower. But still, year to date, still 4 days faster over 2022. Just put that in context, okay? It's still, houses are still selling year to date 4 days faster, year to date, at these rates than they were last year. Mortgage applications ending the week November 18th, up again. This is 2 weeks in a row, up 2.2%. Refinancing's up 1.7%. Purchases up 2.77%. Remember, we were over 7%. 7.08 was the high. We're now down to 6.58, 50 basis points lower. And what's going to happen to this mortgage rate is it's going to go lower faster over time, because if the 10-year Treasury drops and volatility drops, the spread between 10-year Treasuries and the fixed-rate mortgage would also drop. So I expect that this would probably, over time, drop at a rate faster than the 10-year would drop. New home sales for October up 7.5% month over month. This doesn't look like a market that is falling apart, keeping its median price as far as listings is concerned. It's still selling much faster year over year. Your mortgage applications have been ticking up. Mortgage rates are ticking down. New home sales up 7.5%. November 29th, we get the housing price index, the FA housing price index for September. Really backwards looking. Also Case-Shiller at the same time. Another round of mortgage apps November 30th, and pending home sales for October. December 1st at 7 p.m. We also get total vehicle sales for November. It's not housing, but it's interest rate sensitive. But like housing, it has supply shortages. October was 14.9 million, which is a move up. So let's see if we come in greater than 14.9 million. If we do, that's a good sign for the consumer and for the economy. I don't know that that's a good sign for the car companies, because they have very high prices right now because they can sell everything they make. But if the supply problems go away and they can start making everything they can make, can they then sell everything they make at the prices they have? And if they can't, well, that is a downward pressure on inflation, which would be bullish for overall equities, but bearish for the car companies. So I'm going to be keeping my eye on this. There is a big problem with housing right now. We are in a structural shortage, and construction loans are expensive. Builder loans are expensive. We've heard through the earnings calls that a lot of the home builders are no longer building spec homes. Spec homes are, let's build out this subdivision even before it's sold, and we'll sell it as we're building it. Now they only build to sales. So coming out of this, you're not getting a lot of price decline. You're not getting the big price drops that you'd expect to see. Remember, shelter is 32% of CPI, a little bit lower in PCE, but it's still a big component of the services part of GDP. That if you have inflation coming down, and you see inflation coming down, capital markets will start pricing in lower rates, and so will the mortgage market price in lower rates, which will induce more demand, which would put upward pressure on pricing, which would then send the shelter component of CPI back up again. So I can't see how we're going to get out of this without inflation reigniting unless you solve the shortage problem. But the bigger issue in housing for shortage right now, the big one, is labor. And we have a tight labor market. There's not enough slack in the labor market to fix that problem. And immigration is still a hot button issue on this one. So because you haven't solved those two big problems, even if inflation does come down, which I don't know that it's going to melt away, but there's a good argument to make that it'll step down gradually. There's also a good argument to make that it can only step down so far, because as soon as activity starts to increase in response to this, since you're at capacity on labor and housing as it is, since you have these structural shortages, it wouldn't take much upward momentum or upward movement in demand to reignite those prices again. So I think this is a tricky situation to get out of. All the people on the Open Market Committee are intelligent, and the Federal Reserve throughout its whole system employs some more than 400 PhDs. I'm not the only one that can see this. I'm sure they're all aware of that, saying, listen, unless these supply shortages go away, these constraints go away, notably in labor and in housing, if we relent because we see inflation coming down or we see the economy turning down, if we relent, we will only reignite these short fuses. So if I had to bet, I would bet that they are not going to blink at the first signs of deterioration. That the market's going to say, oh, come on, look what's going on here and there, and unemployment is increasing. I don't think they're going to blink. I think to avoid any price pressure in the labor market and in the housing market, they have to first create significant capacity in employment and in housing. They'd have to first create that, because I think they would be well aware that as soon as they released the reins a little, it would start again, and they'd just have to hike from an even higher rate from where they are. They're in a tough spot. So not blinking at the first signs of deterioration is also consistent with what we read in the minutes the day before this video came up. Is the tone of the minutes seemed to indicate that they were more than willing to let that happen to achieve their goal. All right, let's move over to the VIX, which is volatility on the S&P or SPX. My trend lines, by the way, I use closing prices for both of these. In case you're wondering what's going on here, you can use full intraday ranges for them, or you can use closing prices. I use closing prices. Look at this. We have a breakdown below the upward trend, which kind of signals a reversal here of what the trend was. The breakdown is 6.6% below the trend line, and I took, you can't look at this point over here. You have to look at when it happened, at what that value was. It was 21.95. We're sitting at 20.50, so that's 6.6% below, and you've had 4 closings below the trend line. When you're looking for confirmation of a reversal, the greater the percentage and the more days in a row, the more bars. Usually you look for 2 or more. With 4 closings below the trend line and 6.6% below, that is significant evidence that you do have a reversal of a trend and that the volatility is heading down. This is consistent with volatility on treasuries heading down as well. You do have a line of support at 1955 or at 2055, and then you have another one here at 1856. If we're looking on the SPX itself, implied volatility on the SPX, this is implied volatility percentile, the 52, the 26, and the 13 week. I'll put W's behind that so you know that these are weeks. In the past 13 weeks, almost 100% of the observed implied volatility was higher than it is now. If we look at the 52 week, we're at 22 at the 22nd percentile, meaning that 78% of the observations over the last year came in higher than where we are now. If you prefer IV rank, 30, 13, and 0. Look at this in the last 13 weeks. It is becoming less profitable per dollar of margin to sell premium, but it's making it cheaper to buy options. So if we're looking for downside protection for buying puts, well, the premium is low. Not historically low, but over the last 13 weeks, quite low. So buying puts actually is cheaper. Selling them, not so great. There's not a lot of premium there, and there's always a calm before the storm. In the past, this line here has been an indicator to sell the index, and this line up here has been an indicator to buy the index. So we have a breakout over here that seems to be a confirmed breakout from this, but it still could end up being a false breakout and find its way back in. Which means you would be redrawing you'd have to go back and redraw your speed lines. Actually, it would probably look more like this, and you'd have a new trend line because you'd have a lower bottom over here, but not ready to do that. It seems consistent with Treasury vol that this would drop as well. The minutes didn't seem to indicate that was a wrong move at all. The futures market in both Fed funds futures and interbank rates seem to be in agreement with each other. I think we're going to print a PCE report next week that is consistent with the CPI report we saw, which indicates that month over month it was lower, that we are moving in the right direction. And I think you're going to have a positive jobs report on Friday. The Atlanta Fed is printing GDP now greater than 4% for the fourth quarter. I don't see a threat to this rally right now. In the short term, I certainly wouldn't be selling any upside calls on the index anymore. Now, the premium really isn't there. I don't know about puts. Maybe I might buy some puts. I don't know, but we'll look at my levels on the index when we get there. But none of this right now seems to me to indicate that I should be selling the SPX just yet. All right, here is the DXY. Here we have a clear breakdown of the trend line, and we have the DXY at 105.96. 200-day moving average is 106.3. It is now below its 200-day moving average. If you do a 10-year or take a 10-year chart of the DXY, it had in the past, it had two of these peaks that were pretty much around the 102.5 to 103 level, somewhere in here. Long-term 10-year support, we're sitting at 105.96. If we're looking at futures on the index, on the DXY, implied volatility percentile on the 13-week, 33, meaning 67% of all observations in the last 13 weeks were higher. So you do have implied volatility that is dropping on the DXY as well. You have volatility pretty much dropping across the board. It's like this big sigh of relief, on treasuries, on equities, on the DXY. It's like, we can relax for a while. I think that is wrong. I think it's a good opportunity to start thinking about, well, maybe I should buy some puts or maybe buy put spreads. Near term, next 1 to 3 months, I think the DXY is going to be driven by interest rate differentials. So the DXY, I think either sideways or downwards is probably the movement that if I had to do something gun to my head on the DXY, I'd probably most likely sell calls at the 200-day at 106, 106.50 if I had to do something. If I had to pick some part of the distribution that I didn't think would happen, because I think that focus will be put on the Fed slowing down while we haven't seen that yet from other central banks. In Canada, I think we've seen a little bit, but it's not big enough to make much of a difference. What's the risks to this in the near term? The risk, if I were going to say, well, I think our move is to the downside. When I say what's the risk would be, well, we actually go up. Energy and China could send the DXY back up. Remember, we haven't even hit winter yet. So where are energy prices going to go? You've got a lot of Russian, with the sanctions coming up, a lot of Russian energy that's going to be off the market, and OPEC has shown itself perfectly willing to keep the market just slightly undersupplied. Well, that could fuel inflationary pressures back up again, because energy feeds into transportation costs, and transportation costs feeds into the cost of getting anything anywhere, right? China, COVID, this could extend supply issues. Over the weekend, we've seen the Chinese population sort of fight back on this. It's spilled over into Shanghai, where you have actual protests. Think about the rareness of that and the risk of doing that. Actual protests in Xinjiang and in Shanghai about all these lockdowns. But you have COVID cases that went from 24,000 somewhere in the 35,000 range. So they're climbing, and they have big populations, big concentrated populations where this stuff, remember, this stuff is transmissible, highly transmissible. Not as deadly as it used to be, in terms of the effect on the population, because you do have some natural immunity right now, and you do have a high level of vaccination, so it's not as deadly as it used to be, but still highly transmissible. That is increasing as well. I pointed that out as a risk before. I still think it is a risk. If we think that China is going to be the engine of growth like it was in 2007, 2008, 2009, it really didn't get hit by the credit crisis and the property devaluations that Western nations did. So it was able to help the world grow out of that very quickly. Not going to happen this time. I don't see them coming along for this ride. I don't see them being as an engine of growth. Their forecast for GDP is somewhere around 3.5% for 2023. If this doesn't become worse, I don't know that you're going to say, okay, don't worry about it, and have COVID cases not skyrocket. They're going to, and given the size of the population, with big numbers, even though it's not as doesn't have the high mortality rate that you would expect, given big numbers, they end up still being high numbers. So this is my base case here, DXY. I don't know that I see it do this just purely on central bank activity. I think that's pretty much rear view mirror, and the only upside I think now would be risk off, global risk off. And that could come from China. It could come from increased energy prices. In the midterm, next 2 to 4 quarters, the probability of a global recession is mounting every day. You have Canada's yield curves fully inverted. Germany is becoming more inverted. I think almost across the board it has inversions. The U.S. has inversions. We can look at that in a second. So I think the base case is a global recession. The question is, are we talking about a mild, moderate, or severe recession? If China were going to be the engine of growth out of this, and we were looking at a global recession, we could say it could be mild. But if they're not, well, you could be looking at moderate to severe. So what's the risk of this bet? If I said, well, I think the DXY is going to increase in 2 to 4 quarters out, so let me go 6 months out and let me buy calls on the DXY because I think it might go up. My risk to buying calls is that we do actually, in fact, get a soft landing. Okay, this looks like a complicated screen, but it really isn't. It's an open interest matrix, and what I've done is I've selected December 16th, the regular December options expiration date, and this is for the S&P 500. And these are options and open interest on options. This is the 14th, 15th, 16th, all the way to the 25th, so we can see the evolution of open interest. It's a heat map, so your eyes are drawn to the darker green to see where most of the open interest is occurring, and it is happening at 4,000. 4030 is at the money. So let's look at just the evolution. When we want to figure out, well, what does the market think? We can look at open interest. We can look at, well, what are they doing? What they're doing will tell us what they think, because if you think the market's going up, you're not buying puts. Why would you buy puts if you think the market's going up? But if you say, I don't really know if the market's going up, I'm committed to the market, but let me buy some puts. So there's still some fear that the market may decrease, and if you have puts, and then you have to sell into a sell-off, you don't mind selling into the sell-off, because as you're pushing the market down with your selling, your puts are increasing in value, right? Let's go back to November 14th over here, and this is open interest in puts and calls at the 4,000, 14,722 versus 30, a lot more on the calls than the puts. Let's come all the way to the 25th. 30,000 is now 27,000. 14,000 is now 15. So from the 14th to the 25th, as the market has inched its way up over 4,000, I think we're 4,026, 4,025 on the close now. There has been incrementally more puts and incrementally fewer calls. If we look at 39.50, we're going to go 50, there's 4,000, we're going to go 50 down, and we're going to go 50 up. And we're going to have a look at the difference in calls and puts. If we're down at 39.50, we're more interested in the puts. So we went from 8,300 to 11,266. And for the calls, went from 10.5 to 10.5. There has been, as the market has moved up, there has been more put buying than there has been call buying on the way up. At the 4,000, at the 39.50, and for calls, we're looking at the 40.50. You'd have to go above where the market is, and you're looking at the calls. You go below where it is, you're looking at the puts. It doesn't make sense to buy a put at 40.50 when the market's at 40.30. Unless you have some reason why you needed that delta. If you're buying puts, you want to buy cheaper puts. Because if you buy a put at 40.50 and the market goes up, you're just giving away 20 bucks for nothing because you bought the put. You're giving it away, right? So you're buying puts below. That's why we're looking at the 39.50. So I'm seeing puts increase over this period of time at the 39.50. I'm seeing puts increase at the 4,000. I'm seeing calls decrease at the 4,000. I'm seeing them flat at the 40.50. Overall, the puts seem to have it. And this is for the December 16th expiration. However, not so much. It's not so skewed on one side that you say, oh, well. And typically you'd expect to see more put buying than call buying on the index anyway. So it's not out of line, but we do have to be aware that, 39.50, as the market has moved up from November 14th to November 25th, your open interest went from 8,300 to 11.6, from 14.7 to 15.3, but it has not for the calls. By the way, you can get this on the CME site once you have an account. You can grab all sorts of tools like this. And all I've done, heat map here, I've just clicked on OI for heat map. But there's a bunch of other things that you can get as well. And you can select whatever expiration date that you want. Okay, let's categorize the type of recessions here. Mild, moderate, and severe, and there are measurements for it. Mild recessions typically last 2 to 4 quarters. Moderates are 3 to 4 quarters, and severe is more than 4 quarters. By the way, this is what the UK is forecasting, 8 quarters of negative GDP. Real GDP in a mild recession contracts by as much as, terrible color there, by as much as 0.5%. But not much more. Moderate, you're negative 0.5 to negative 2.5, and severe recessions, you have a contraction of 2.5% or more of GDP. Unemployment for mild recessions will increase by up to 1.25%. I put plus 1.25%, negative plus 1.25% or less. Moderate recessions are 1.25% to 3%. And severe recessions are 3% or more. And this is consistent. The relationship between GDP and unemployment here is consistent with Okun's law. And it does have some empirical evidence here. 1% drop in real GDP translates roughly into slightly less than a 2% increase in unemployment. Slightly less than 2%. So it's based on where potential GDP is. So if potential real GDP is 2.4%, if you actually get a growth rate of 2.4%, you'll get stable unemployment. In other words, unemployment will not increase or decrease. So it's not as if we're looking at the 0% growth to determine the increase or decrease in unemployment. It's the trend growth. So if you go from 2.4% to 3.4%, that's 1% above trend. It is expected that unemployment will drop about 0.5%. If you drop from 2.4 to 0.4, unemployment should increase by about 4%, because it's only just the difference from the trend, right? Now, this makes a big assumption. Okun's law makes a big assumption. It assumes that real GDP is equal to population plus productivity growth, which is pretty much how we measure real GDP, with stable participation rate. Okun's law did not hold in 2008, 2009 because you did not have a stable participation rate. So what happened was, for a decrease in GDP, you had a much bigger jump in unemployment than Okun's law would suggest, and that's only because the participation rate did not remain stable, but lowered. This time, if we do have a recession, this is going to be rather interesting, because the generation that's leaving, the boomers that are retiring, are a far larger generation than Gen Z, which is the generation that is entering. We haven't had that yet. Each generation was bigger than the one before it. So every retiring generation, those that were leaving, were a smaller cohort than the generation coming into the workforce each year. It's the other way around. this year, which means that you're not going to have a stable participation rate. I think you're going to have a dropping participation rate over the next 4 or 5 years. We already see that we have a participation rate that's struggling at 62.2, 62.3, 62.4, in around there. I don't see that increasing dramatically unless we have a shift in demographics, and the only way you're going to get that is immigration. I'm not seeing that happening. So let's look at what the estimate is and the forecast for 2023. 2022, 75% of the data is already in, and we do have some data that's unfolded over the course of November. So it's expected real GDP in around 1.8% for 2022. The forecast for 2023 from Goldman Sachs is 1.1. That's a drop of 0.7. That would be, to be consistent with Okun's law, that would mean unemployment would increase by 1.4%. The conference board is at 0% for 2023. That would be really negative for equities, by the way. That implies a jump of 3.5% in unemployment, but because of this demographic situation, I think this is doubtful. I don't think that you're going to see much relief in the labor market, which is another problem for the Fed. And remember now, if mortgage rates get too low, you're going to refuel shelter pricing. If unemployment, if you can't get slack in the job market, if you do start to lower interest rates, what's going to happen is, because you didn't create enough slack in the job market, there's only going to be that existing and continuing pressure on wages going up, because you're not getting this. Because you're getting this, not getting the opposite. You're getting a shrinking participation rate. I can't see an easy way out of this. I'm pretty sure the Fed recognizes there's no way out of this unless they create significant slack in the labor market. And if they can create significant slack in the labor market, maybe some of those people can go to the housing sector. Maybe, this worker is laid off from this firm but has construction skills and can go over into the housing market. That's going to be a while to create that kind of shift in employment. Combine that with how many battery factories are being built in the U.S. right now, right? You have battery factories. Ford and GM are both building 3-4 big battery factories. Combine that with a lot of assembly. That's not right, the word just in case. Assembly that's scheduled to come back to the U.S. If you're reshoring and nearshoring, where are you going to get the jobs from? Where are you going to get the people from? Mexico seems like the good alternative here, which is why I'm still bullish on the peso, because this is a problem in the U.S. Companies are going to see it's a problem in the U.S., but Mexico has cheap labor and they have a large population, and all the immigrants have to travel through Mexico before they get to the U.S. So if you make Mexico the land of opportunity, you can solve a whole bunch of problems all at the same time. I say a bunch of problems. We have a labor problem, but there's also an immigration problem in the sense that there's kind of a negative sentiment towards it. So, why not make another country the land of opportunity? Then that negative sentiment is like, we didn't want them here anyways and not going to get them. So everybody wins. Okay, let's look at the SPX. Let's look at our index. This is the SPY up, the ETF. SPX closing on Friday, 40.26.12, forward EPS 224.96. That puts us at a 17.898 multiple, pushing 18. 18 is just sitting slightly above it. 18 times is 404 on the SPY, 404.96. And I've, from last week, replicated the upside resistance we have. 404.79 is the 200-day moving average. We are roughly about 20 points on the SPX below that. 404.96 is 18 times earnings. 406.88, that's our downtrend resistance, this line right here. 408.52, we have our upside gap that we need to fill in. The upside gap happened back here. that still hasn't been filled in. SPY closed at 402.01. This is just different levels of resistance. More fundamentally speaking, you have fixed income yields and a move into duration that are rather desirable. So as the index keeps going up, if you're increasing the multiple at which you're willing to pay, take the inverse of the multiple, 1/18, to get an earnings yield, and compare that earnings yield with what you can get on fixed income without the risk, and probably higher return if you have interest rates dropping. Duration on 30-year, that's a nice price increase. Volatility dropping, spreads dropping. You're going to get competition in fixed income. Also, winter's coming, so watch energy prices, because energy prices will suck dollars away from consumers that would spend it somewhere else. And China COVID, this is a fight you have to fight on the upside. On the downside, the uptrend, this line right here, 388.09, and we've seen that whenever we've had sell-offs in the last 2 weeks, around 391, 392, they've been well supported. 17 times at 382.43. You have a downside gap at 381.14, and the 50-day moving average is at 378.26. This is a 100-point range. This is all within a 40-point range. We're closer to here than we are to here. If I had to bet, I would seem to think that the market would try to push up through this first before it went down. I just don't see going into Monday what major catalyst we have to change the sentiment that's been going on the last couple of weeks. You know, we're still excited about the Fed slowing down. More funds are excited about the drop in volatility across the board. You have a drop in volatility in S&P as well. It's a lowering of the fear index. If fewer people are fearful, maybe they might not be willing to sell so quickly. 16 times, 3,600, there's our recession concern level. And let's just add a little bit of weight to the 16. IBES, Q4 EPS year over year, expected to be negative 0.4% for the fourth quarter. 2023 EPS forecasts have dropped 15% in the last 6 months based on forecasts from FactSet. So if you go back 6 months and you look at what the 2023 EPS forecasts were versus now, they are down 15% over those 6 months. Goldman Sachs for 2023, EPS 0% over 2022. 2022 is expected to come in at 220. And we have forward EPS, forward 4-quarter EPS of 224.96. That includes the fourth quarter plus the first 3 quarters of 2023. So if we're just going to use a multiple of 2023 at 220, 0% growth, a drop of 15% over here, negative 0.4. You have a forecast of GDP for 2023 of 0.5%. None of this is consistent with pushing up to a 20 times earnings. None of that is consistent. None of that is consistent with 18 times, which is why I put 18 times up here as resistance, because the higher you go, valuation issues are just going to be front and center. Is every point up, valuation becomes a louder and louder word going, where are we going? None of this going on is consistent with higher multiples or a multiple expansion. If anything, it's consistent with a multiple contraction. 17 makes a lot of sense until we get some clarity on what we think the economy is going to look like, because I think we're at heightened uncertainty. The Fed, in the Fed minutes, said they give a 50-50 chance to their base case versus recession. Now, Bloomberg is 100% recession, and most of the estimates I see for recession are somewhere between 50 and 100%, but not below 50. I don't see anyone saying, oh, it's 20% probability of recession. So we are on recession watch. Everything we're seeing is consistent with being in the late slowdown. The yield curve inversions are screaming at us right now. So the drop in volatility now, I think is very near term, but I don't think it can hold up long term. Near term, I think that we can look past all of this and say, look, we can rally maybe into the end of the year, a narrative widely believed can become true. Santa Claus rally, it's going to happen. Who's going to stand in front of that? It might convince enough buyers to buy and enough sellers to say, let's give it a little while before we sell the market. But sell the market they will. So I don't see that any of this is consistent with okay, maybe you'll test 18, but 19, 20, 21, I've heard this joker. I don't know why anybody listens to this guy. He's from Fundstrat or whatever. Now he's screaming 4,500 by year end. He had 4,800 and inflation would go to zero by the end of the year. Melt away. And, it just never happened. Now he's screaming 4,500. I'm thinking, how are you getting there? Like, that's not well thought out. That's just gunslinger approach. That's just shooting numbers out to shoot numbers out. Maybe you need those levels for your fund to get the returns so you don't lose clients. I don't know. I can't see it. So I seem to think 17 times is probably a fair price to be, given what we know and what we don't know at this point in time. And then once clarity starts to come in, we might say, okay, you know what, we can justify a higher multiple, or no, we need to justify a lower multiple. But I think 17 would be our jumping off point. I am short the S&P 500. You can see from this red line over here that I actually do have a short position in around 393, 394. I plan to keep it. And I am selling calls on the market because I don't mind being short. But I don't think I'm going to sell anymore. I think I'm good. I will wait to see what happens and go from there. But I'm not going to close any of my long positions, because my long positions will enjoy the ride up. And I don't think that I'm going to add any more to my short position on the SPY, because it is large enough now that I'm still net long on my portfolio. So if the market goes up, I go up and enjoy it with it. I have added to my IYR calls. IYR. I'm selling calls on the IYR. I've added some 88 calls as well for December, because the dividend yield on that is too low, and having seen some of the earnings reports for some of the components, especially negative NOI growth year over year for the office properties, I just think it hasn't seen enough downside yet, that I think it's probably going to see sub 75, sub 70 before it's over. Let's look at the calendar for the week ahead, and we'll wrap it up. Okay, it is a big week this week. We've got the JOLT survey, you've got PCE, you've got more looks at GDP, you've got jobs report on Friday, and we're hearing from Jay Powell himself this week, the big guy. So November 28th, we have some Fed speak. November 29th, Canada gets some GDP, gets a GDP look. Although this is rear view mirror, because we get month to month to month. This is just for the full quarter. There's the house price index for September, along with Case-Shiller for September. Backwards looking. I don't know that really has a lot of impact. Consumer confidence. Let's keep our eye on this, because how people feel will translate into how they behave. Mortgage applications, GDP growth rate for the second quarter. This is our second look. Sorry, not the second quarter, for the third quarter. This is our second look at third quarter GDP. We've already seen it once, so it's our second look. Pending home sales. There we go. We have Cook, and then at 1:30 you have Powell. This is on Wednesday at 1:30. That's going to be listened to. That he's not going to say something would be very odd. It's not like he's giving a commemoration address to something and he's going to talk about how wonderful somebody is. He's going to say something. So I'd be watching this. Then you have the beige book at 2. Here's the core PCE, December 1st, Thursday, 8:30, PCE. I, again, expect this to be consistent with what you saw for CPI. I don't know that there'll be any new information here. However, if it does come in lower, consistent with what CPI did, the market will see this as another piece of evidence, as opposed to, no, It's the same evidence, just a different look at it. It's for the same period of time. You're measuring the same thing, you're just measuring it differently. That's all it is, but the market will probably see it as, oh, there's even more evidence. Meanwhile, it's not more evidence. It's the same evidence, just in a different color, right? Continuing jobless claims, we have initial jobless claims. We'll look at that. You're also going to get personal income and personal spending. That comes with the PCE, because PCE is personal consumption expenditure. So you get the price index, you get personal income, personal spending. Logan, Bowman, you get construction spending, PMI. It's the S&P PMI, not as important as the ISM. ISM still is the the leader here in terms of what's more important. That's at 10 o'clock. There's another Fed speak. There's your vehicle sales Thursday night at 7. Friday morning, let's see how GM and Ford and Tesla open up. Then both Canada and the US, you get employment change. And the big one to look at here is going to be the participation rate. Previous was 62.2. Gotta see that starting to tick up. Average hourly earnings, 4.6. Gotta see that coming down. If you see that coming down, that means there's growing slack in the labor market where employees don't have the pricing power that they used to have. Then you got Evans at 10.15. I think, for Canada, if we're looking at where the Canadian dollar is going to go, I think this is the big one at the end of the week, that if this comes in strong, look at last time, 108,000. I don't think we're going to repeat that. The forecast is for negative 10,000. So even if you get zero job growth, that's still better than forecast. That could push the Canadian dollar past the 132.5 to the US dollar, maybe down to 130. Maybe we could see 130 on it, but it's having trouble at 133 and change. It got to 132.5 in around that region before bouncing off that. That if this comes in strong enough, well, that could signal that the Bank of Canada could increase rates more and still be okay because employment is strong. Lots to look at next week, lots to be aware of, but I think the first big one here is all eyes are going to be Wednesday at 1:30, and he is speaking before you're going to see PCE. So will what he says nullify any good news on PCE? So if he comes out and he says, the market is not pricing in our terminal rate, we see that it's pricing in 5%. If he makes any hint that the market is underpricing where the rate is going to go, and he makes a big deal about that, yeah, that could nullify any good news on PCE, because the belief is that, well, we thought it was 5, now it's going to be what, 5.5, 5.75? Got to listen to that one. That's all I got for you this week.